What's going on, YouTube family? My name is Steven Rogerson. If you're not familiar with who I am already, I have been a full-time day trader and investor in the stock market for the last 5 years, and I'm the head trader and owner of NoCapTrading. NoCapTrading is a friendly investment community where we discuss the stock market, the cryptocurrency market, and the foreign exchange market to all help like-minded individuals come together and all help out each other during our investment journey. Today's video was a recorded live educational class that I hosted for some of the members where we discuss an introduction to the stock market, introduction to short selling and how you could actually make money when stocks decrease in price, introduction to futures trading, and introduction to options trading with a live Q&A at the end. The Q&A is pretty informational, so I suggest to watch this video fully through. But with that being said, if you would like to be a part of the next live class that I host, watch me trade live in the stock market Monday through Friday, or just be part of the community and hopefully get some helpful tips and tricks, please feel free to click on the link below to join the free Discord server. Before we jump into and get started, I would like to put out a little disclaimer that I am not a financial advisor. Anything that you see in this video is strictly for educational purposes only, and you should always do your own due diligence. And last but not least, just please go ahead and slap that thumbs up button, give me a like to help out that YouTube algorithm, and please consider subscribing since I am a smaller YouTube channel. Thank you. So just to let everybody know before we do get started, this will be pre-recorded so I could upload it to YouTube later for the people that do miss it. For anybody that doesn't know, my name is Steven Rogerson. I'm the owner of NoCapTrading. I have been a full-time day trader for the last 4 years. I've been day trading in the stock market for around 6 or 7 years. And today I just threw together a quick little presentation covering, the introduction to the stock market, introduction to what short selling is, introduction to futures, introduction to options, and at the end, we'll save some time for a Q&A. So if we could just confirm, please, that everybody could see my screen, I'll get it and jump right into it. Everyone can see me? All right, awesome. Thank you, guys. So before we get started, I actually threw a disclosure in here, and it's a disclaimer. I just want to throw it out there that, I am not a financial advisor. This is solely for educational purposes only. Everybody is required to do their own due diligence and their own research. All investments will be strictly your responsibility that you make. So, introduction to stocks. Now, what actually is a stock? So a stock is a partial ownership of a publicly traded company. Now, are all companies publicly traded? No, they're not. So a company like Apple, as a retail investor like myself and yourself, we can purchase a share of Apple and own partial of the company. But something like SpaceX, which is privately owned and privately traded, we cannot, as a retail investor, purchase them. So why do companies sell partial ownership of themselves? So first and foremost, it's just to simply raise capital. So they want to raise capital from investors to attempt to reinvest these funds to expand and grow the company. If it's expansion as in buying new products, creating new things, whatever it is, but that's why they raise the capital. So how do they actually go public? This is known as an initial public offering. The process for a company to go public and sell equity of the company is known as initial public offering, also known as an IPO. This is the first time a company goes public to retail investors to purchase equity inside the company. Now, are stocks unlimited? Simply stated, they are not unlimited. So if stocks were actually endless and had an endless limit, like some of these cryptocurrencies, there'd be actually no true intrinsic value because any single time someone would purchase a share of a company, the company would just make another share. So each company has a limited amount of total shares, and this is known as your outstanding shares. So what causes now stocks to actually change in valuation and change in price? Well, first and foremost, the most common reason is supply and demand. Like I just said before, there's a total amount of total existing shares known as outstanding shares. So if there are more buyers than there are sellers, the price will increase and vice versa. Another thing would be an outstanding catalyst, something going on with the company, some pending news, possibly some earnings reports that are going on, how the company is doing, if they, reached their quota, if they missed their quota, if they got a new product, if the CEO gets kidnapped, like all that different stuff. So what exactly is supply and demand? Since there's a limited amount of shares that are available of each company, securities valuations will change based off of the supply and demand. So if there are more buyers currently purchasing the security than there are sellers trying to sell the security, that creates a demand for the limited amount of total outstanding shares that are available. This will represent an increase in the security's valuation. This is known as the buyers are in control. Now, vice versa, if there are more sellers currently selling the security than there are buyers trying to purchase the security, this creates a surplus or a larger supply. This will represent a decrease in the security's valuation. This is known as sellers are in control. Now, how do you actually earn profits from trading? So how can you actually earn profits from trading? Simply buy a security at a cheaper valuation, hold it until it increases in price, and then resell it for a profit. So just to give you guys a quick example, stock ABC is currently trading at $100 per share today. Tomorrow it increases to $101, and then I decide to sell it, and now I profited that $1. I paid $100 for it, I sold it for $101. It's known as buy low, sell high. Now, what happens when I assume a stock value will actually decrease in value? So if you know bad news comes out on a stock for whatever reason, you think the stock will decrease in value, there's been a bad earnings report, they aren't really doing much, etc., you can actually make money when a stock decreases in value. So if you're under the assumption that a security will decrease in value, you can actually capitalize on this, and this is known as short selling. So chapter 2, this is known as shorting. Short selling is the process of short selling. The process of short selling is the complete opposite of buy low, sell high. How this process works is you will submit an order to your broker account to sell the security short. The broker then will retrieve these shares for you and instantly sell them at its current valuation. So just to give you guys a quick example, if stock ABC is trading at $10 per share right now, you go short it. You want to just short one share of it. Your broker then will give you that share and give you a credit of $10 per share. And the whole purpose of this is you want to purchase this share back to return it back to your broker at a cheaper price. So if stock ABC you short at $10, you have a $10 value of that stock because you just sold that stock. And then it decreases down to, let's just say, $9 per share. You now buy that share back at $9, return the share back to your broker. Now, the broker does not care about the current price or the value of the share, of the valuation of the security. The broker will act as the middleman for you because they don't actually own the share that they're letting you borrow. All they care about is the return of that specific share. Now, how short selling actually works. Let's say you assume a company stock will decrease in value. You decide to short sell one share at $10, like I just said before, and then it drops down to $9. You buy it back at a cheaper valuation. Now you keep that $1 in profit, and all you have to do is pretty much pay your broker a very, very small commission rate. I believe the rates are like around 8% if you hold a short for an entire year. So all you have to do is calculate 8% divided by 252 trading days in the year, and literally the rates are like nothing. But that being said, there are some small fees. So what actually happens if you're wrong with a short? So when you're actually buying a stock long, which means that you own the company, your maximum loss is whatever you actually invested. So stock ABC is currently at $10. They actually go bankrupt and the company gets delisted. Your maximum loss on that stock, because you own it, is only $10. That's because a company could never go negative in value. So your maximum loss is known. It's whatever you actually originally invested. But with short selling, since you owe the broker the share back at a later date, if this share increases in value, you still need to purchase that share back no matter what at a later time. So when it comes down to short selling, the potential loss is actually endless. The reason the potential loss is endless is there's no limitations on how high a stock can actually go. Short selling is a lot more dangerous and should be done only after you've proven to yourself that you can follow your game plan, stick to your rules, and have an exact exit plan in case the trade does go against you. So any single time that you want to get into a short position, you want to know where you're entering and where you're exiting. So let's just say a stock is at $10. You want to set up your stop loss, let's say at $11. So if it breaks at $11, it sells instantly. So you don't ever lose more than that $1. So what happens if you do not actually close this short as it increases in price? If you are wrong and the security continues to increase in value, while you have an open short position, you will need the available funds in your brokerage account to mitigate the loss. So what I actually mean by that is, let's just say you have $100 in your broker account currently. You short one share at $80. That stock then increases in price. So the broker gets concerned that if that stock goes over $100, you'll be in debt to them and you will not have enough money to repurchase the share back at a later time. So when the stock gets close to your available balance limits, the broker would then issue you a margin call. Now, what is a margin call? A margin call is when the position starts to get close to its maximum potential loss, the broker will issue you a margin call, which is also known as a courtesy call. They are informing you that if you do not add additional funds to the account immediately or close the current open position and it continues to increase in price, they will be forced to have to close that position for you. And yes, this is 100% legal. This is something in the contracts that you agree upon, when you actually sign up for the brokers. And this is honestly just to protect the broker. Because God forbid you only had $100 in that account, that share went over $100 per share. What would actually happen is you would be in debt to the broker, and then now they're chasing you for money. So of course they want to avoid that by all costs. So what is considered a short squeeze? Everybody is pretty familiar with a short squeeze now because of GameStop. But a short squeeze occurs when a stock or other asset jumps sharply higher, forcing traders who had a bet that the price would fall, aka a short position, to buy it in order to forestall even greater losses. So when you close a short position, you actually become the buyer. So if you remember before, I said you're borrowing the share and then at a later time you're purchasing it back to return that share. So when you close that short position, you're becoming the buyer now because you need to return that share to your broker. This will actually continue to create more demand, aka more buyers, and add to the upward pressure on the stock's price. And then we could use an example like GameStop, where it jumped from like $17 to $500. So what happened with GameStop is they had a very short high interest float, which is the amount of total outstanding shares that are being shorted at the current time. And then when Reddit jumped in the masses with a $2 million group chat and everybody bought it all at the same time, it skyrocketed the price because of supply and demand. And then it squeezed out and short squeezed all of the hedge funds and everybody that was actually short in GameStop. So Chapter 1, Intro to Futures. And by the way, guys, if anybody does have questions, please feel free to unmute yourself and stop me. I'm sure everybody will learn from, a little bit of everyone's questions. So Chapter 3, Introduction to Futures. Now, futures trade a little bit differently than the stock market. The stock market, it usually opens up around like 6 or 7 a.m. And then, the actual live market will start at 9:30 a.m. So from like 6 a.m. or technically 4 a.m. to 9:30 will be pre-market. And then from 9:30 a.m. to 4 p.m. will be the open market. And then you have after hours. So futures trade actually 23 hours a day, 6 days a week. So futures will start trading at 6 p.m. Eastern Standard Time on a Sunday. And they will remain open until Friday after hours when they close at 5 p.m. Now, when I say they trade 23 hours per day, futures actually take a little break, it's called. So between 5 p.m. and 6 p.m. every single day, they actually go on a little pause to reset themselves and recalculate. And they just do not trade on Saturdays. So a day like today, which is a Sunday, I'd actually be trading futures at 6 p.m. right now. So futures, what are futures? Futures trading consists of the trading of future contracts of goods and services. A futures contract is an agreement between the buyer and the seller of the contract that some assets, such as commodities, will be bought or sold for a specific price on a specific date. Now, what type of futures contracts actually are there? So there's a bunch of different futures contracts, and a lot of people aren't really too familiar with this. There's actually commodity futures, which, you're trading goods. Stuff like soy, corn, oil, wheat, stuff like that. I personally don't like trading that stuff. I don't like the way that it moves, but there are future contracts that exist for it. What I prefer are the index futures and the metals. So there's stock index futures like the S&P 500, which is SPY, the NASDAQ 100, and the Dow Jones, which is like the US 30. And then we also have precious metal futures, which is gold, silver, copper, and all that stuff. Now, how do they actually work? So futures work much differently than a stock. So every single future will have its own separate tick value, tick size, and initial margin requirement. What a tick size pretty much represents is how much the contract changes in between prices. So with stocks, they will change for every single penny. Like a share of Apple can go from $130 to $130.01 or $129.99. So stocks will change in every single penny, and they're all pretty much identical unless it's like penny stocks that have partials. But futures trade a little differently. They trade with tick size. So tick size is a predetermined change in price. I'll cover that in a little bit. But they also have now a tick value. So every single time that this future contract changes in a tick size, it will always have a specific value. So let's just say, each tick size of the change is 25 cents, right? So that futures contract can go from $100 to $100.25 or $99.75. It will not go in between. It will only move in intervals of 25 cents. Now, every single tick will have its own specific tick value. And then every single futures contract will also have an initial margin requirement, which is how much buying power your broker requires for you to actually buy that futures contract. Now, tick size, let's break it down a little bit more. So each future contract, like I said, will have their own predetermined tick size. The S&P 500, which is also the SPY, their tick size is 25 cents. And then, something like a gold, their tick size is 1 cent. And now what is tick value? This is simply how much you will profit or lose on each fluctuation in the tick size. So just to give you some quick examples, the NASDAQ 100, the tick value is $5 per tick, and they will move in increments of tick size of 25 cents. And their current price of the initial margin requirement is $13,905 per contract. So what is the initial margin requirement? So first and foremost, to actually apply for futures trading approval, your account must have margin approval as well. At secondary level 2, futures approval will be needed. So if you aren't already trading futures or have never applied for futures trading, you'll actually need to apply for it on your broker's website, kind of like how you had to apply for it for options. So if anybody's trading options right now, if you remember, you've had to apply one time or another. So in a margin account, you have leveraged buying power. So depending on your broker and what you're approved on is how much buying power you have. But just to give you guys a quick example, if you have 2-to-1 buying power, or leverage, this means the broker will put up $2 for every $1 that you deposit. So let's just say you had $25,000, your buying power then would be $50,000. So that means that you can spend up to $50,000 in trading power, known as buying power. So the $25,000 that you have, the broker would then match. So what we were talking about before with the margin call, this also happens when you're trading with buying power. So I'm going to use that same example. Let's just say I had $25,000 in my account. I take a $50,000 position. That $50,000 position decreases, let's say 40-50% in value. Because I have a $50,000 position, but only $25,000 of that is my money, since that trade decreased 50%, I technically had double the size loss, and now I wiped out my entire $25,000. I'll get a margin call, they'll close out the position, they'll take their 25 grand, I'll be left with zero. And that's pretty much how that works with the buying power. So you always need to be very careful and considerate of margin calls. So like I was saying before, the NASDAQ 100 initial margin requirement is $17,000. And every single tick is 25 cents, and each tick value is $5 per tick. So let's just say that's moving a little too quick for you. That's just too expensive for you. You don't have enough buying power. There's something actually called micro E-mini contracts. So a normal futures contract is considered an E-mini, and there's a micro E-mini. So some future contracts will actually offer different size contracts. So if a normal contract changes too quickly in valuation for your liking and or you do not have enough available initial margin, you can use a micro contract. So just to break down a quick comparison, this is the S&P 500, also known as the SPY. It's /ES, which is the futures contract name. It's the E-mini S&P 500. Their tick size is 25 cents per tick. Their tick valuation is $12.50, and their initial margin requirement is 17,300. So any single time the S&P 500 changes a single tick, you're either going to make or lose $12.50. So just to pretty much put that into speculation really quickly, anytime I take a futures trade in the S&P 500, my profit or loss is probably increasing or decreasing anywhere from $200 to $1,000 per minute. It's very, very fast because $12.50 per tick value is very, very large. So a lot of people tend to not be able to stomach those types of fluctuation. So they'll tend to trade a micro E-mini contract, which would then be 1/10 of the size. So just to break down really quickly how it would work, let's just say you enter into the S&P 500 E-mini at 4,175 is your entry price. You then later close it that same day at 4,200. So you profited 25 points or 100 ticks. It's 100 ticks because each tick is valued at 25 cents each. And then 25 points times 0.25 ticks is 100 ticks. So what would actually your profit on that would actually be $1,250. And now I do not, encourage this for beginners or people with small accounts. If you do have a small account or, you're a beginning trader, you haven't dabbled yet with futures, please start with the micro E-minis because they are very, very emotional. I've made or lost sometimes $2,000-$3,000 in a minute. if it's moving very, very quickly. So just to compare the two really quickly, on /MES, which is a micro E-mini version of the S&P 500, it has the same tick size of 25 cents, but now their tick value is $1.25 instead of the previous $12.50. So you could actually see it's actually 1/10 of the size. So the initial margin requirement, of course, is much less for this contract. So the initial margin requirement for this is $1,210. So same exact equation, we enter at 4,175, close at 4,200. We profit 25 points or 100 ticks. On that same trade, we made $125 versus the $12.50 that we made in the previous trade because it's 1/10 of the size. Now, futures contracts are not made to buy and hold because we're traders. We're not investors. We're not trying to, God forbid, get 25 pounds of corn mailed to us, anything like that. So the holder of a futures contract is obligated to carry out the terms of the contract. In the contract, it will detail the quantity and the date of the commodity in advance. So pretty much just never hold these long term, and so these are solely for only trading. I've never actually held a futures contract overnight, or I've actually even never held it for more than like an hour or two. So as a trader, this is known as flipping the contract. So what we're doing is we're buying the contract for one specific price in hopes to resell that same contract at a higher price later on. So chapter 4, we're gonna, we're speeding through this pretty quick. But chapter 4, introduction to options. So options are a little complex. This is just going to be very basic options just to get everybody pretty much caught up. And then I could get a little bit deeper into this and multiple different ways to trade options. But I just wanted to cover the basics before, I confuse a lot of people. And this will be a little advanced for some and a little over some people's heads. But, just stick with it because options is where the real money's at. So if you buy an options contract, it grants you the right, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. A call option gives the holder the right to buy a stock at a specific price on a specific date. So just to pretty much break that down, let's say I buy a contract. It expires next Friday. I'm buying it for stock ABC. I agree to pay next Friday $8 per share for stock ABC. What as a trader we would do is we would flip the contract. So we would pay a premium, it's called, for the specific contract, and then hopefully resell that same contract for a higher premium. But if you were to quote unquote exercise the contract, which means that you wanted to fulfill the contract, you wanted to actually buy those shares on that specific expiration date at that specific price, this is known as exercising. So what it actually does, it allows you to buy 100 shares of that stock at a specific price on a specific date. So, and then a put option would be the complete opposite. So a put option gives the holder the right to sell a stock for a specific price on a specific date. So when you buy a naked call option, you're assuming the stock will go up. And when you're buying a naked put option, you're assuming the stock will go down. So calls versus puts. When you purchase a naked option call, you are agreeing to purchase 100 shares per contract at a specific price known as your strike price on a specific date, which is known as your expiration date. If you own an options contract and it expires below the strike price of that contract, this contract will expire worthless and you will not be obligated to purchase those 100 shares. So that's the nice thing about options. It protects you a little bit. Your maximum loss is only the premium that you pay for the contract. So God forbid, stock ABC closes on Friday at $7.50, but I have an $8 options call. All I did was lose whatever premium I put into that trade. So what are puts? Puts are when you purchase a naked puts option contract, you are buying the rights to sell the underlying asset as a specific fixed price known as your strike price on a specific date known as your expiration date. So you are pretty much assuming that this will decrease in value. A put options buyer makes a profit if the price falls below the strike price before the expiration date. So if you're very new to options, I suggest that you start with only naked calls at first. And then you start dabbling with puts a little bit later on. But as a new trader, always start with just only naked calls, in my opinion at least. So what is the premium? The premium is the upfront cost that you pay or you collect for the rights to that contract. The premium is calculated per share. So just a quick little breakdown. Each options contract will have the rights to 100 shares per contract. So if there's a $1 strike per share, you do $1 times the 100 shares per contract, and then your premium would equal $100. So that's how much you would pay for the rights to that contract. So that premium as a trader is what we try to flip. So if that stock increased quickly in price and that premium now jumps from $100 to $150, we just made 50% return or $50 on flipping that contract. So how do we actually read an options contract? Now, I sometimes will call out options contracts that I'm either entering, and a lot of people get confused on how to actually read them. So starting from left to right, AAPL, that's actually the stock's ticker symbol. That represents Apple. Next, we'll have the expiration date of that contract. Third, we'll have the strike price. So you'll see on my example, I have 120C. 120C means C stands for call, and then if I had 120P, that means that I was buying a put or I was in a put position. And last but not least is the premium, which is, like I said, $1.65. But remember, we have to multiply that per share, and there's 100 shares per contract. So the premium of this contract would be $165. So this right here is a screenshot. Sorry if it's a little bit blurry for you guys. This is known as your options chain. What the options chain actually is how you can pick out your different contracts and you could read the contracts. So starting from left to right, if you look up on the top left in the white, it will say volume. So that's how much the daily volume of that specific contract was traded. So we could see the 20 strike had 9,800 volume. So what does that show you as a trader? You got to remember, when we're trading stocks, we want things that have high volume in them, because there's something called a bid and there's an ask. A bid is what buyers are willing to pay for it, and an ask are what sellers are willing to sell it for. And this is known as your spread. So we always want to avoid either options or stocks that have high spreads, because anytime we either enter or exit a trade or want to get in or out of a trade, we want to pay as minimal as possible. So, if a stock or an options contract has very low volume, they'll have a bigger spread because there's less buyers and less sellers of that commodity. And same thing with options. So we always want to keep an eye on our volume. Volume is very, very important when it comes to both options contracts and futures. Next, we have our open interest. Our open interest is actually the total amount of contracts that were written at that specific strike price. So that's another thing. It's pretty much identical to the overall volume of that options contract. So the volume on the left actually represents the daily volume, and the open interest will represent the total amount of contracts that were written at that specific strike price. Next, we'll have the bid, which is what buyers are willing to pay for the stock or for the options contract. The ask are what sellers are willing to accept for the sale of that contract. Moving on down, we have the expiration, EXP. That's the day that the contract expires. And then a little further on the end of the right, we have the specific strike price. The strike price, like I said before, is the agreed upon price to pay for that share of the company on that specific expiration date. So the cheaper the strike, or the lower the strike, the more expensive the contract, because you're agreeing to pay a cheaper amount. And the higher the strike price, the cheaper the contract will be, because you're agreeing to pay more at the end of that contract for those shares. So these are now Greeks. The Greeks are how we actually calculate how much the contract will increase or decrease in valuation, and the premiums will change. So the Greeks provide a way to measure the sensitivity of an options price to various multiple different factors. So there are 4 major Greeks. The first and most important one is the delta. The delta is a measurement of how much an options price is expected to change per $1 change in the price of the underlying security or index. So what I mean by that is, if I buy a contract of, let's just say, Apple's currently trading at $100. Apple then goes to $101 as I own this contract. The delta is a measurement of how much my premium will increase in value for that $1 change. So if I have a 60 delta, that means that my $100 contract went now to $160 because of that $1 increase in stock price. So that is a great example of why options are so promising. So it costs you $100. The stock price only changed $1 and you made $60 on that. So if you just bought one share of Apple for $100, instead of buying that options contract and it increased to $101, you only made $1 difference. But if you bought an options contract for $100 on a $100 stock, and it went to $101 and your premium jumped from 100 to 160, now with that same $100 investment, you made $60 versus the $1 owning the stock. So that's why options are so promising. So if you ever see anybody ever post in the chat, 50, 100, 200, 300% growth in an options contract, that's why. And that's why options contracts are so promising. And that's where the real money is made, because you don't need a lot of money to actually make money with options. So next, we have the gamma. The gamma represents the rate of change between an options delta and the underlying asset's price. Next, we'll have the vega. The vega is a measurement of an option's sensitivity to implied volatility. So implied volatility is pretty much just a fancy word for how much we expect this stock to increase or decrease in value. So implied volatility will change around specific dates. So if there's nothing going on with the stock and the stock isn't very volatile, which means that it moves very quickly, the implied volatility will be very low. But let's say, you have an earnings report coming up for the stock and it's a very volatile stock, something like the cryptocurrency stocks. The implied volatility will be very, very high because we're expecting this asset to change very quickly in price and fluctuate up and down very quickly. And last but not least, we have the data. The data represents the risk of time and the loss of value of an option. It is always expressed as a negative figure. So whatever the data is, let's say it's a $30 data. What that pretty much means is every single day that you own that contract, it actually loses value. So it would lose $30 per day until the expiration date comes up. Why that actually happens is the likelihood of your contract increasing in price. So the more time that you have on a contract, of course, the better. The more time you give a contract and the more time you give a stock to increase in value, the more it can possibly grow, and vice versa. So the data will represent how much your contract actually loses in value every single day. So it will always represent in a negative figure. So ITM, ATM, and OTM. You'll see these on the options chain. You'll see me type it in the chat all the time. ITM stands for in the money. So an ITM contract is the current options contract is already within its strike price. So let's just say I bought a strike price on stock ABC that was currently trading at $100, and I bought a strike price for $90. What that pretty much shows me is that contract is already worth something because it's in the money. It could be exercised, it could be executed. So what tends to happen with these contracts is they're much more expensive because there's a lot less likelihood for it to drop down to 90 or under 90 within that time frame, as well as the premiums do not change very quickly. So the premiums won't really change as quickly on a contract that's in the money because it's already going to expire worth something. So you got to remember, if a contract expires out of the money, it's worthless, like I said before, and you lose your entire premium. So ATM, that's at the money. At the money pretty much means that the current options contract is identical to the strike price. So if it either fluctuates up or down, will determine if the contract goes in the money or out of the money. So if the stock's currently trading at $100 per share, I buy a $100 strike price, that means I'm at the money on that. And last but not least, out of the money, or OTM. So the current options contract is outside the strike price. These contracts would tend to be cheaper because, God forbid, they expired. They are considered worthless at this current time, and they will tend to move a lot quicker, and their premiums will change a lot quicker as the contract or as the underlying asset increasing and decreases in price. So as a trader, I like to usually trade, I call it +2 -2. So if a stock is trading at $100 per share right now, that means that I will play the strike prices between 98, 99, 100, 101, or 102. I'll tend to usually go OTM on them so I can try to make a bigger return on my flip of the contract and make a bigger return on the premium. So it really comes down to preference. As you're beginning trading, I suggest that you go in the money so you can get your feet wet a little bit with how options actually work, because OTM contracts will tend to move very quickly. I've purchased contracts before, and a matter of 5 minutes, they've moved 40, 50%. So a 40, 50% return on a trade is very, very quick, very good. So that's usually what tends to happen with OTM contracts. So This is also known, like I said before, as flipping contract premiums. We never, as traders, want to ever try to exercise these contracts and hold them into the expiration date, because if we hold them to the expiration date and they expire in the money, what's going to actually tend to happen, or what will happen, is we'll be obligated to buy those 100 shares. So if we have a contract that is, let's just say, a strike price of $100, it expires, the stock is worth $101. I now agreed as the owner of that contract to purchase 100 shares at $100 each, which means I need $10,000 of buying power to purchase those shares. So as a trader, what we actually do is we flip the contracts. We never hold them into expiration date. So that was pretty much sums up the little quick lesson. If anybody has any questions, wants me to review anything or go over anything, please feel free. Now's the time.
Steven, we had a couple of people ask some questions in the chat.
Okay, let me go through the chat really quick. Are you trading on this or TD Ameritrade? So I trade on Thinkorswim. So Thinkorswim is the TD Ameritrade's platform. So just to pull up Thinkorswim really quickly for you guys. This is what Thinkorswim looks like. This is a very, very advanced broker, and there's a lot of options to trade with. And really quickly, we have a gold futures up right now. So you could see this is what gold has been doing on the last 1 year. So are Greeks seen visually on the charts? So I'll actually pull up an options chain for you live. So you click the trade button right here on the TD Ameritrade platform, and this is what an option chain actually looks like. So you go to layout right here, you change your layout to the different Greeks, which will be Delta, Gamma, Theta, and Vega, and then you pull them up. So you could see your Delta right here for this contract. Let me pull up more strike prices. So you can see the Delta for this contract is 75 cents, 70 cents, 65 cents, etc. The Gamma is 1 cent, and the Theta is minus 92 cents. Remember, I said Theta will always represent in a negative amount because that's how much your contract will decrease in value every single day. And then the bid is what buyers are willing to pay for it, and the ask are what sellers are willing to accept for the sale of it. So what tends to happen is if you submit a market order, you'll get filled somewhere in between this. So you'll get filled somewhere between $1,170 or $1,220. So that's a $50 spread on this contract right here, because you got to remember we got to multiply this by 100, and we'll probably pay around $25 in premium for the rights to that contract. Let me see, what other questions do we have? Are there situations where some stocks will only trade large contracts and no other options for micro contracts? So micro contracts are actually only for the index funds. The micro contracts, like the /MES, which is the micro E-mini contract, that's an index fund. What an index fund is, it's pretty much just a giant pool of a giant portfolio and a giant pool of multiple different stocks all in one. So if you want to own like the overall market, but you don't have $10,000 to purchase it, purchase a bunch of different stocks, you could actually purchase one share of the S&P 500, also known as SPY. That will represent the 500 biggest companies in the overall market. And we tend to actually use the S&P 500 as a overall health meter of how the overall markets are doing. And then something like the NASDAQ. NASDAQ is the 100 biggest technology companies. So if you think technology will be hot right now, you can buy one share of NASDAQ and you have, access to 100 multiple different shares. That's how index funds work. For futures trading, you need larger capital. Yes and no. So with futures contracts, I'll actually pull them up for you guys real quick, and I'll show you how to actually pull them up for yourself. So type in a futures contract here. So let's do just /ES, right? You click on the little down arrow here. This is the symbol table. You click on symbol table, and then you just go 4 over on the top to futures. Once you click futures, this will give you the tick size, the tick value, and the initial margin that is required, and all of the available futures that you can trade. So right here, we have the micro E-mini S&P 500 up. This only has an initial margin requirement of $1,200. So TD Ameritrade gives me like a 2 to 1 or 3 to 1 margin. So what that pretty much means is all I really need is like $400 to $600, and then they'll match the other half to give me that $1,200 total for that initial margin for that contract. But if you go to, let's scroll up to /ES, now that initial margin is $12,000 because the valuation and the tick valuation changes so quickly. By the way, guys, you could get off mute if people have their mics plugged in. You don't have to type no more. So if you sell before the expiration date, options in there relatively are as safe as trading stocks. So the difference between options and stocks is options will tend to move a lot quicker, and pretty much you're only responsible for the premium. So we got to check the measurement, which would be the delta, for how how quick that options contract will either increase or decrease in price. So options will tend to be a little bit more risky, but you know your maximum loss. And the reason why they're more risky is they're a lot less forgiving. So let's say you buy at the wrong time, the stock decreases, 2%, that options contract most likely, depending on, all of the Greeks, but that options contract most likely lost anywhere from 10 to, 30%. So you have to be pretty spot on and laser focused when you're trading options. And when it comes to options trading, I always tell everybody, learn how to day trade stocks first, no matter what. Because options, you'll just throw in that giant curveball and you'll have all those extra Greeks you need to worry about and you'll be limited. So any single time, let's just say you buy a stock of Apple, right? You buy a stock at Apple for $130, it decreases to $125, by Friday. With that options contract, if it expired, that options contract would go down to zero because of that decrease. But as long as you own the share, you don't actually technically accept your loss, quote unquote, until you sell it. So although it went from $130 when you purchased it to $125 and you have a $5 current loss for it, you still own it and it could still increase and rebound in price. So with shares, you can actually give them time and you're not limited on when that contract expires. So that's why shares are much safer. So can you do a limit order? So right now I'm not doing any trades right now, but just to pretty much do a limit order, I could pull up my active trader right here. This is what I trade solely off of. This right here will be a volume scanner for me, so I know how many contracts are being traded right now. This will be another version of my level 2. And now this is why I actually love Thinkorswim's platform so much. This is active trader. So what this actually is, this is the bid size. So you can see all these little numbers right here, 38, 57, 68. That's how many buyers are at this specific price on a limit order. And this is how many sellers are at a specific price on a sale order. So another word for that would be your level 2, which would be this. So your level 2 right here would be scanning all of the buyers and all of the sellers. So this right here is just an easier version to read of level 2. And level 2 is very helpful because level 2 will show you who's in control. So if you guys remember before, I said stocks tend to move based off the supply and demand. So who's in control? Is there more buyers or are there more sellers? So level 2 is one of actually the best ways to determine when to enter and when to exit a day trade, as well as your volume. So this right over here, to break it down very quickly, this is your volume average 50. How you could actually install this on your Thinkorswim is you go up top over here to your studies, you click edit studies, and then you type in volume average here. So I already have it installed right here. You can see volume average. So this will show me who was in control for this candle. So let me just switch this over to a 5-minute candle really quickly. So we could see that this big spike right here, there was giant buy orders coming in. You could see that we have an increase in your overall volume, which gave us an increase in the size that it increased how quickly. Versus, over here, we could see the volume now died out, and now the stock is starting to trend sideways and trade sideways. So that being said, volume, level 2, and your active trader will determine when you can enter and exit some trades. Those would just be a bunch of tools to help you. If I wanted to do a limit order, though, to answer your question, I could either right click up here wherever I want to place the order. So if I want to right click right here, I could go buy single, and then it will pre-fill me at the specific price that I wanted to fill it at. Or I could go right over here and I click the buy button. So if I clicked buy over here, I'll do that really quickly. Let me just send that order. You could see I have a buy limit if it reaches up here, which is a limit order. And then same thing with the sale order. So I'm going to go ahead and just cancel that out by pressing this little X.
I guess I'm a little confused when you go to when you're buying options.
So let me pull up the option chain again for you. Right? I'm sorry, go ahead.
Like when you go to buy options.
Okay.
confused on the process because like, you're kind of like buying it at you said you buy it at a premium, right?
So the thing is, you're paying a premium for the rights to that contract.
Okay.
It's just for the rights of that contract.
Okay.
So
And
let's use another example that's not stock related, right? Let's say that you find somebody selling a house that's like a fix and flip, right? They're asking $80,000 for it. You put it under contract that next Friday you'll purchase it for $80,000. You now go find a new buyer to buy that house for $100,000. You now sell that contract for $80,000 to the buyer that's willing to pay $100,000, and now you profit that $20,000 difference. That's called house flipping
and
contract.
I say you said what, 18%?
Well, what do you mean 18%?
Well, didn't you say you like based on the contract that you're given, they take like a certain percentage of it?
So no. So when you actually purchase an options contract, what will actually happen is the broker will have a small fee attached to it. So if you ever want to buy an options contract, you highlight the ask button right over here. You want to make sure that you're under the call section, which will be on the left over here, and then over here is on the put section. So you can see calls right here, and then puts over here. So if you want to buy a naked call option, you would just highlight the ask part right here, and then click which contract you want to buy. So if I wanted to buy the 130 strike for $171, I click buy right here. My order tab would come up here, and then I could click confirm and send. And then now this right here, so you could see how much I'm paying for the rights to this contract. So the broker, it's charging me $6.50 for this contract to buy 10 of these contracts. So it's really 65 cents per contract. I had it pre-filled on 10 on accident. So let me actually just change that over to 1 really quickly. So you see it says plus 10 right here. We're going to just change that over to 1 contract to show you 1 contract. So you can see 1 contract right here is $171, and there's a 65-cent fee from my broker to buy that contract. But that's the only fee that's attached to the broker or to buying options contracts. What I believe you're speaking of is the spread. So I'm going to use the same example is the buyers are willing to buy for $165, but the sellers are only willing to sell it for $171. So you can see that there's a $6 spread on this contract, right? 165, 171. This one's 223, 232. So there's a little bit bigger of a spread on this contract, like around $11. So this contract right here, if you were to place a market order, which means that you want to get filled instantly, you want to get it in the trade no matter what, you don't care how much you pay for it, quote unquote, as long as it's reasonable, you'll get filled somewhere probably in between the bid and the ask. So you'll probably, that's called the spread. You'll get filled between your spread. So you could see something like over here where it's only $80 for this contract. That's what the buyers are willing to pay for it, the bid, and then the sellers are willing to sell it for $83. The spread is only $3 per contract. So now you'll probably only pay like $1 or $2 for that spread to get instantly filled. If you do not want to pay any spreads, what you can do is you could submit a limit order. If you submit a limit order right down here on your order tool, you could go over to price right here, and then you could actually put in order type, limit, market, stop, stop limit, trail stop, and all these other ones. So if I want to get instantly filled on this right here, I would change my order type over to market. Market will instantly get me right into the price. But if I don't want to, deal with the spreads and risk potentially missing the trade, I can put in a limit order. So now what a limit order pretty much would do, it tells the broker, hey, I want to buy this contract, but I'm only willing to pay $171 per contract no matter what for it. So what we would actually need to wait for is we would need to wait for this contract to decrease a little bit where it would actually decrease the price down to $171 per contract. Just so we could avoid the spread. So if there's a bigger spread, I'll tend to do a limit order, but if it's a small spread, I'll just throw in a market order because I want to get in and out of the trade. And I'll tell you this from personal experience. I've missed a lot of trades by doing limit orders and being greedy of those, $3 or $4 of the spread. And then I miss out on, a few $100s on the trade or the potential of the trade. So, it's all really comes down to preference. But, if you want to quickly get in, quickly get out, and make sure you get into the trade, you have to do a market order. What are the most efficient ways to short a stock? I really like shorting stocks around catalyst. Now, what catalysts are? It's current events. So, being a trader and, seeing stuff live. Let's say a report comes out, something really bad. A factory goes on fire, a new lawsuit, the CEO gets kidnapped, whatever it is. We'll see a giant decrease in that stock or that asset's price very, very quickly. Because what tends to actually happen is these things called algorithms, they read news headlines. What an algorithm is, it's pretty much a giant, human-made computer that's built and coded to trade stocks. And one of the ways that algorithms actually trade is off of news headlines. So if you ever see good or bad news come out, you'll always see those giant drops or those giant pushes in the valuation of the stock because of algorithms either getting in or getting out. So the best way to actually, and the most efficient way to ever short a stock is around bad news, around bad earnings, and when sellers are really strong and are, and we're starting to see, the sellers just completely take over. So something over here, like you can start to see the sellers right here really took over. So we could see this giant volume bar of all sellers coming in. We would want to capitalize on that. We would want to get in on this trade and then hop in on a short and then quickly close it after we start to see this reversal. Far as trading platforms, do you recommend downloading them or using the web is just as good? So Benz, it really matters which trading platform you're using. There's a bunch of different trading platforms. I personally, I love TD Ameritrade and Thinkorswim's platform. That's what I've been trading on for the last 5 years. This has a lot of great tools. There's a lot of learning material on it. Like just to go through some of the different tools that you can use. Literally look at this list. So these are all different indicators to help you succeed at trading. So these are all different tools that you can go through and determine if you want to use or not to help determine when to enter and exit trades. So we could see that this broker just offers a lot. You can pretty much trade everything on it. You could trade futures, options, stocks, commodities. You could trade pretty much anything and everything, even forex you could trade on this broker. So I highly suggest this broker. This broker was actually rated is one of only 2 brokers that had a 5.0 star rating of 2020. That being said, if I know a lot of people are using like Robinhood, which is a phone app. The problem with Robinhood is they have these things called delayed data. Delayed data, what that actually means is if a stock, like I said, they change very quickly in price. So as the stock is increasing and decreasing in price, you have delayed quotes. So if it's currently trading at $100 per share, Robinhood might tell you it's $100.05. And then you submit an order to buy it at $100.05. And then guess what? They actually paid $100 per share for it, or $100 per share for the transaction of that share. And they capitalize on that 5 cents that they pretty much stole from you. So Robin the Hood. That's pretty much what Robinhood stands for. So Robinhood is considered a free broker, and they actually made $6.8 billion by doing that in the last 2 years.
Wow.
Yeah, so honestly, get off Robinhood, they're shit. What are the best Greeks and how do you pick the right options? So option picking really comes down to your preference of trading style. So the closer that an options contract is closer to its expiration date is how quickly the options contract will move. So when we're closer to the expiration date, we'll see an increase in delta. That being said, as a trader, I want to quickly get in and quickly get out of those trades. So I like to trade 1 to 2 week contracts. So this is my options chain pulled up right here. You can see that these contracts expire on May 14th. Obviously I'm on a different date, by the way. So these expire in 5 days. These expire in 12, 19, 26, etc., etc., etc. So as a trader, all I'm doing, if you guys remember, I said this before, was flipping the premiums. What I mean by flipping the premiums is all I want to do is capitalize on those quick moves, buy a contract, and then resell it for a more expensive price later on. So the way I could do that is I buy a contract that's closer to its expiration date because I know the valuation of that contract will fluctuate much quicker than something that has more time on it. So if I was to trade, let's say, a contract for next year, right? Those would tend to move much slower because there's so much more time on those contracts to either increase or decrease in price. But if something's very close to that expiration date, it has a lot less time, so it'll be very more, fluctuate very quickly and very more often. And you'll have a very high delta on stuff like that. So what I'll tend to do is, depending on the day and depending on the contract, depending on the stock, I'll usually trade 1 to 3 weeks contracts. Like I said before, I'd like to do the +2 -2. So if I was trading Apple right here, Apple's currently $130 per share. I'd probably go with a 132, 133 out of the money options call that expires this Friday. So what that's pretty much telling me is I'm expecting this stock to pretty much push $2 or $3 per share within the next 5 days. But if I wanted to be a little bit on the safer side, I could play a 126, 127 call. But of course, you could see that these are a lot more expensive because of the certainty that these will expire in the money versus currently out of the money. So we'll make most of our money by playing out of the money or at the money contracts, because you got to remember the premiums and the deltas will be much higher on those because the probability of them expiring is less. So think about it as just like a little teeter system on how to a little teeter system on the likelihood of it expiring in the money or out of the money. Do I look at the graph before taking any trades? When you say the graph, do you mean my chart? What do you mean by graph? I'm sorry, Miguel.
Yes.
Okay, yeah. So pretty much, I'm using all of my different indicators. So what I'll actually do is I'll go up here real quick and I'll click detach. What detach will do is actually give me a second window of my TD Ameritrade. So I do trade on multiple screens. So what I'll actually do is on this one right here, I'll have my chart up, and then this one right here, I'll go to trades and I'll have my options chain up. So you got to remember the other chart would be on my other screen, so I could be watching both at the same time. So as I'm watching the chart increase in value and I'm waiting for my entry and the right time to enter the trade based off my price action, I'll also be watching the changes in the options contracts and how much they're increasing and decreasing in price as well, and then base all of that off of when I enter and exit a trade.
I think that's the biggest difference from like switching over from Robinhood to TD Ameritrade for me is that you're able to see the volume. So like it's not all gamble. Like,
Honestly, yeah, trading on Robinhood, you're gambling a lot.
Gambling.
Yeah, you have a very small chart. You can't really do proper charting. You can't identify key levels. The screen is too small. If you pull up a chart, you're off of your watch list. You lose sight of everything else you're watching. Plus the spreads are ridiculous. Delayed quotes. They don't have customer service.
Exactly.
If you guys can't tell, I hate Robinhood.
And Jasmine's asking her account's under 25K, and yeah, so Jasmine option trades, you get 3 option trades per week per 5-day trading period.
Okay, so Jasmine, your account's under PDT. So if anybody's not familiar with what PDT is, thank you, Jasmine. I actually forgot to include that in here. What PDT actually is, it's the pennant day trading rule. The United States is actually the only country in the world that has this rule. What the rule pretty much says is if you have less than $25,000 in your margin account, you are limited to 3 round-trip trades in a 5-day trading period. Now, what I mean by a round-trip trade, that is the purchase and a sale within the same trading day. So if you purchase a stock, let's just say Apple at 9:30 a.m., and then you purchase another share at 10:30, that is not considered a round-trip trade because you didn't buy and sell it. It was only 2 separate buy orders. So you need to buy and sell within the same day, and that'll consider 1 round-trip trade. So if you're under $25,000 in a margin account, you are limited to only 3 of those within a 5-day trading period. And now when I say 5-day trading period, I don't mean, every single Monday it refreshes. No. So if you make 1 trade on a Monday, 1 round trip trade on a Monday, 1 round trip trade on a Tuesday, and then a Wednesday, you're not going to have another trade into that next Monday for that first trade to clear. But Jasmine, one thing you could actually do is you could actually get off of Robinhood first and foremost. And the reason why I say that is Robinhood only offers you margin accounts. There's these things called cash accounts. What a cash account actually is, it kind of works like a check. So with a cash account, let's just say you have $10,000 in your brokerage account. With that cash account, you could do unlimited amount of trades up to that $10,000. So you could make 5 trades of $2,000 each. You could make 10 trades of $1,000 each. You could make 20 trades of $500 each. You get unlimited amounts of trades with the amount that you have in that account. The only thing is with cash accounts is you need to wait for the money to clear. And that's why I say it's like a check. So if you ever get a paycheck or, somebody gives you a check and you need to deposit it, it always goes through that 1 or 2 day clearance, right? So that's kind of how the cash account works as well. So if you're trading options, it's actually really cool because you'll have next day clearance. So if you have $10,000 in that account, in a cash account, and you do $10,000 worth of options trades, that next morning at 9:30 a.m., you'll have that $10,000 refreshed again in your account to trade the next day. But if you're trading shares of a company, it actually takes 2 days to clear. So if you have $10,000 in that account and you want to trade shares, what I always tell all of my students is break it up in half. So day one, trade 5,000, day two, trade the other 5,000, and then by day three, that initial first 5,000 you traded on day one will already clear because it's a 2-day clearance.
I think that's it with the questions.
Yeah, guys, if actually everybody is all done with questions, I'm gonna clean this up and I'm gonna go grab something to eat because I'm starving. I hope I helped everybody out and answered everybody's questions. If anybody else does have questions, so please shoot it my way right now before we sign off.
How does
Go ahead.
premium price gets how does the premium gets decided? And my second question is the short setting. Suppose I'm trying to short a stock, and if I hold for a few days, does TD Ameritrade charges any fees or anything?
Yes, so the fees that are attached on shorting, it all would determine the different short that you're in. I believe it's around like 8.5% per year. So what pretty much happens is they'll divide 8.5% divided by the 252 trading days in a year. And here, so let me actually pull this over really quickly. Can you guys see this? Okay. So we could see right here, TD Ameritrade short selling cost. It will be 9.5% to 6.7%, 6.75% annually. So that's not per day, that's annually. So all you have to do is pretty much calculate, however long you want to hold that for, divided by, 252 trading days or trading days within a year. And I'm sorry, go ahead and just repeat your first question.
The premium for an options contract.
Yes.
How does it get decided? Like we see.
There's these things called option writers and market makers. So market makers will determine how likely how often the stock moves, how quick it moves, how much it goes up and down, the volatility, the implied volatility, and the average premium for those contracts. So the market makers actually determine the original premiums, and then the premiums will fluctuate up and down based off of your Greeks, like the deltas and the gammas.
And for example, TD Ameritrade, this exchange does not have the stock to borrow, and I still want to short that stock. How do I find which broker has that?
That's actually a really good question. Thank you for that question. I forgot to mention this as well. So that being said, there will be ETB, HTB, and NTB. What that pretty much stands for is easy to borrow, which means that there's a bunch of shares that are available to borrow. HTB is hard to borrow. So now if it's a hard to borrow stock, the broker will most likely charge you a little bit more money to borrow those shares because if it's harder to get, there's a limited supply of those, as well as you'll need special rights in that account. So in TD Ameritrade, you actually need over $100,000 of cash in your account to get accepted for HTB trades on shorts. And then NTB is nothing to borrow. So there's pretty much just no shares available to short, kind of like what happened with GameStop. And you just won't be able to short it. And now to answer your question, to determine which broker will have the shares or won't have the shares, you'd have to actually reach out individually to each broker and see if they're ETB, HTB, or NTB.
So can you use GameStop as an example, and explain how shorting works and that give that specific example?
Yeah. Give me just 1 second. So we could see GameStop over here, right? This is let me pull up a 90-day chart. All right, let's go back to the 180. I lied. Okay. So we could see over here, what price was this? Like $20, right? And then it shot up to $500. There's this thing called short interest float. Short interest float is the amount of total shares that are being shorted at one time. So short interest float is what actually caused GameStop to go so bananas. So Reddit mass bought the Reddit group, Wall Street Bets, they mass bought the stock all at the same time, giving this initial skyrocket in price. So you could see over here is when the buying started to happen. Look at this huge candle right here. Look at this huge blue volume candle right there. That's where this initial buying started. Let me zoom in a little bit for you, right? So you can see the initial buying really started over here, right? started to slowly increase, and then we saw the mass push up was right here from $103 all the way to 500 in a very short amount of time. So this right here is where the squeeze started happening. So that was considered a short squeeze. So what tended to happen was everybody that was shorting the stock originally now had to cover their shorts, aka become the buyer. And then now there was already a mass amount of buyers from Reddit, Wall Street, and everybody chasing this. And then the people that were short now has to become buyers. And now that was just like a double whammy for the amount of buyers that came in, just skyrocketing the price all at one time. So let me just pull up FinViz really quickly for you, and I'll show you how to actually find the short interest float of a stock.
So it caused, okay, so I get how like Reddit, they had like a mass, like everybody started buying shares of the stock and it went like way up.
Yes.
But shorting it, wouldn't you be making money off of the
So
stock coming back down?
if you continue to hold it.
We've all felt this gap
Sorry about the commercial.
between what is and what could be.
Sorry about that. But yeah, so if you were, let's say you entered a short up here, right? So your average short price now, which means that you asked the broker to sell you a share at $500 right here at the top, right?
Right.
You asked the broker to give you a valuation of $500 per share that you wanted to short, right? So what they did was they gave you a share. You sold it instantly for $500. It happens automatically when you short. It's not actually something you actually do. And then, it drops down. Let's just say, you cover your short right here at $100, right? Now you buy that share back for $100, but you already have a $500 credit from up here on it. So what actually happened is you just made 400% return, or $400 on your short. But the thing is, everybody that was short over here on the stock, when it pushed up, they were losing so much money they needed to close their short. When they had to close their short because they were losing so much money, because remember, when you're losing money on a short, the losses are endless.
So I guess my question is too, like, wouldn't it be smart? So not only like when you said when you try to short a company, it's like you usually want to do that if something bad happens, like they catch a lawsuit or
Yes.
or they have like a bad returns or anything like that.
Yeah,
that
very
happens,
strong
that
selling
causes
pressure.
stock
The
to
sellers
go
are in control.
like XRP or like Plug.
Well,
Or no.
XRP is a crypto, but
Yeah,
like
yeah, that's
like
crypto.
Plug right now. Let's see what's going on with Plug.
Right.
So we can see that there's been a strong downtrend, right? You got to remember the trend is your friend. So this over here is your drawing tool. So we could go over here like this, and we could see that there's been a strong downtrend right over here. It's kind of respecting a little bit of a channel like that, right? So we can start to see a little bit of a bear flag forming. So this is your flagpole right here, and now this is your flagpoles.
Yeah.
This is the flag, excuse me, and this is the pole. So that being said, if we start to see it dropping right over here, right, we want to start entering a short on the next pull up. So we see this rejection. We could look right over here, and we could see that there is a previous support level, right? So if we zoom in a little bit, let me go over my cursor. So if we zoom in a little bit right here, you could see that this was an important level for the stock, right? It tested it twice. So this was an important level once, caused it to crash. After this, it broke out and had a nice big green candle, retested it, and broke below it again, right? So what this is showing me right here is this is my potential resistance. So now you never want to enter on a first or a second test. You always want to enter on a third test. The third test on a failed resistance break is usually when it drops the hardest. So, so you could see on this third test over here, right? 1, 2, 3. Now this started the strong drop. Retested over here now. Now we could use this level over here as your next resistance, and then you can now re-enter another short.
So you'd be entering shorts that whole time then?
I would be trying to, so you got to remember, I wouldn't have this bottom line formed yet because I didn't know any of this existed.
Right, you don't know. Yeah.
So I would be trying to identify where to cover my short and close it for the best available profits, which would be over here, right? So we could see right here, right? This candle was a giant red candle. We always want to look at the biggest candles to try to identify our support and resistance because that's where big price action happened. Either big buyers came in there or big sellers stepped in, right? We don't really care about the small candles. Small candles don't do shit for us. So this candle right here, you can see it's a large candle, right? Where my mouse is. came up, retested this candle failed to break this line. The next candle, you got to remember, every single one of these candles represents a 4-hour time frame. So in 4 hours, this stock couldn't break it. Couldn't break it another 4 hours. Couldn't break it another 4 hours and failed again. Now, right here, look, failed to break it again, came back down. Right here on this candle, it broke above your resistance. So it started to push. So what I would do is I would cover my short here so I could lock in my profits right there. That's how I would have took that trade.
Okay.
And then same exact thing over here is I would try to re-enter a short, right? After I saw that this stock got rejected for 4, 8, 12, 16, 18, 20, 24 hours. For 24 hours, for an entire day, this stock failed to break this level, and then strong seller pressure came in. Look at this volume candle, how strong this is. And then we have the massive sell-off right there. So this would have been my sign for another re-entry in a short on this big volume candle. You can see
I don't even know how to analyze like you're doing right now.
That's what the course is for.
Well, yeah, I'm planning on getting it, so.
I got you, boss man.
But yeah.
But so this right here is FinViz. So this is how I was telling you could actually look up all of the data on every single stock. So we're looking at Tesla right here, right? So this is a chart of Tesla. We could see that we have a potential resistance right up here, right? So we could see it hit here, failed to break, failed to break, failed to break, failed to break, failed to break. So this right here could be a potential short if it retests this level over here. And then if it breaks above it, that's when you close the position for a small loss. And that's how you minimize your losses. But if we scroll on down over here, we could go through everything related to Tesla. So the current market cap, which is how much the company is worth, is $650 billion. The income, the sales, all that, all that jazz if you really want to break it down. But right over here, you can see short interest float. So short float is 6.64%. So that's not a very high short interest float. That means that out of the total outstanding shares that are available, which are 963 million shares, only 6% of those are being sold short right now. So what that shows me is that people are very bullish on Tesla for the long term. So what I pretty much mean by that is out of those, let's say 1 billion shares, only 60 million of them are being sold short, and then 940 million of them are being traded or held long. So long term, would I short Tesla? No. Short term, yes.
Yeah.
And then that's FinViz. That's a very important website. All right, let me just pull up chat real quick. Did anybody else have any questions?
So when you do a put to short it,
You could either short the shares, or if you want an options contract, you would buy a naked put.
so I want it to be lower than whatever it's at.
What do you mean by that?
$3 cheaper. So you would buy a put that's cheaper, that's $3 cheaper than whatever it's at. Just anticipating for it to go down.
Yeah, so you make money when it's under the strike price. So whatever agreed upon price to sell it at, you make money for anything under it. So let's say you buy a naked put, the contract is $100, right? Or $100 strike price, right? It drops down to $95 by the expiration date. You already agreed to sell that bad boy for $100 per share. Guess what? You just made $5 per share. You just made $500 because there's 100 shares in that contract. Where do we find the interest and days to cover when shorting? So the interest is really just based off of your broker. So if you're, I wouldn't really be too worried about the interest that the broker charges on shorts, because shorts you're only really going to hold for either a few hours or a few days. And the fees are very, very small. So like I said, it's 6% for the entire year. So if you hold something for, let's just say 20 days, you'd probably pay 0.6%, something very, very minimal. That being said, if you are worried or interested in the interest rates of shorting, I would contact whichever broker you're using and ask them their rates. And there is no specific day on when you need to cover your short, as long as you don't get a margin call. So as long as the stock doesn't increase in price enough where it outweighs your account balance.
On TD Ameritrade, when I use options, they say weekly play, not weekly play. What is that?
Oh, okay. I know exactly what you're talking about. So right over here, right? So you could say you could see it says weekly right here. That means that these contracts, option contracts, are mainly weekly. They always expire on Fridays unless it's an index fund. But If it's a weekly contract, that means that those contracts were written for the week. There's also monthly, quarterly, and yearly contracts. So you could scroll on down. Let's, look at this next one right here. It's in gray. So this is either a monthly, a quarterly, or a annual contract. So what tends to actually happen with these is they have very low volume, and as a day trader, since we're only flipping premiums and we're not exercising these contracts and these rights to the contracts, we actually never play these contracts. So we'll only play weekly because of course, you got to remember, we want higher volume. So let's go over to volume really quickly. We could see that there is, 2,500, contracts of this specific strike price being traded in one day. But if we pull up something like this, look at this. 500, 340, 700, stuff like that. So what tends to happen with the monthly, quarterly, and annual contracts is they have very low volume in them. So what we'll see is actually a much bigger spread, and it'll be much harder to get in and out, and they won't fluctuate as good in price. So you always will trade a weekly contract on your options chain.
Just additional, like the volume and open interest. What is open interest again?
Open interest is the total amount of contracts that were written.
And the volume?
Volume is how many contracts were traded that day. So if there were 1,000 total contracts written, but it went from, my hand to your hand, my hand to your hand, like, 20, 40 times, there could be sometimes more volume in one day than total contracts written.
Okay.
But
But-
guys, we trade live every morning, 9:30 to 11 or whatever. So if you guys ever want to join us on Discord.
Yeah, and you could always talk to me live and ask me questions live, follow my trades. I'll give you live call outs, whatever you guys want. Like I said, I do all this for free. I make more than enough money from trading that I don't need to charge people for this like everybody else. I kind of just like having a dope, nice, friendly family community, and everybody just contributes, helps each other out, good vibes, good energy, and that's it.
Do you mind going back to the slide where you shared trading the E-mini of futures?
Also, another side question too. When do you think? I mean, I don't want to like rush you or anything, but like, when do you think you're gonna come out with the course?
4 to 6 weeks.
Oh, okay.
Yeah, so it's about halfway completed right now. I'm a perfectionist. So I'll tend to, redo a bunch of it, rewrite it, change it around.
Right.
Yesterday I actually worked on it from 11 a.m. to 3 in the morning, straight through, no breaks. I really haven't had a day off in about 4 months. That's just the type of person I am. I just work kind of hard. But
We can ask like any questions we might have in the like about the course.
oh, of course, yeah. I actually in the course I actually provide you with my personal cell phone number, so you can literally text me directly at 3 o'clock in the morning and you'll get a response.
Okay.
Like I said, I actually care about my people, not like the rest of the people in this industry.
Alright.
Yeah, I actually bought a second cell phone just to give people that option. But yeah, you could feel free to ask away. Like, man, even if you're going through the course and you're personally confused on it, you rewatch that lecture or that chapter 2-3 times. I'll hop on a
Right.
FaceTime. I'll hop on a FaceTime or a Zoom meeting with you, and I'll break it down. I don't care. I sat on like a 2-hour Zoom meeting the other day with Miss Bud, just freaking breaking down TD Ameritrade. I literally blew her mind. She had no clue what this broker had to offer.
Yeah, that's cool.
But
I was like, wow.
you're like, wow, this went much longer than I thought. But you asked me to pull up the E-minis. So this is the E-mini. Did you want me to pull up the symbol table, which is this?
Yeah, Steve, I think you spoke.
Yeah, yes. I mean, I wanted to know how I never traded futures, but the 1/10 of future, if I wanted to trade, I wanted to know the process and cost would occur to buy.
So what you would actually do is you would go through the list and you would look for the micro E-mini future. So I'll just give you a little cheat code on it. It's /MES. So /ES is the S&P 500, and then MES is the micro S&P 500. So you just type in /MES. And then now this will be identical to the normal S&P 500 future, but the only thing is it's a micro contract. So you'll pay a lot less on it. So you just click the little down button right here to open up your symbol table, go over to futures, micro E-mini S&P 500. Now each tick value is $1.25 versus the $12.50 of the normal sized one. And now your initial margin is like 1/10 or 1/15 of the cost. Because of course, since the contract moves much slower and is much smaller, the initial margin that's required is much less.
I see. Like options, you buy call and put. So, but futures.
Futures, you're just buying the rights to the contract. You could even short futures. So if I wanted to short a future right now, right here, I would just click the sell button and I would be short one future.
Just like buying a stock in a way.
Yes, exactly. But the thing is, these have predetermined tick values and tick sizes, and that's pretty much it, and an initial margin. So like I said before, a stock will change, usually, every penny. But, every single future contract will have a different tick size and tick valuation. Like you could see right over here, this is a live future. So you can see, look, it's 0.75. If you give this like another, like 3 seconds or so, it'll probably go to 0.50 or 0, just like that. So you see it's moving in increments of 25 cents. So the tick size and the tick value is what's different with futures compared to shares.
Let's see. Okay. And one last question.
Go ahead.
So one of the options when you try to buy, so like if you could pick an example of an Amazon option, and then what are the when you look at the delta, theta, I just wanted to know your perspective on it. How do you look at the delta, theta, all this gamma vector?
So it really determines, based off of what stock you're trading, how volatile the stock is, which is the measurement of how quickly the stock will increase and decrease in price. So a stock that like Riot or Mara, for example, Miss was very familiar with those. They're cryptocurrency related stocks. So because crypto is so volatile right now, those stocks are very volatile. So we could see 15, 20, 25, 30% changes in those stock prices every single day. So if that contract, if that stock I know tends to move 10, 20, 30% per day, I know that the implied volatility, which is the expected move of that options contract, will be much higher. So that's one thing you always need to look for is your implied volatility, which is this right here. So on the bottom right over here on the contract state, you'll get an implied volatility. So you could see, since this is Apple that we're looking at right now, Apple is such a big company worth over $2 trillion. They don't really fluctuate too much in price. They'll usually change a 0.5% to like 3% per day, and that's it. And they'll usually stay within a range. So the implied volatility, which is the expected move in that contract, is very low. But let me pull up Riot really quickly. Riot's very volatile. We know the volatility on Riot is very, very quickly. So you could see the jump in the implied volatility. So now your implied volatility on this contract is 140% versus where it was 25% in Apple. I think I answered your question.
Yes.
Okay.
Yeah, thank you.
Yeah, so it's pretty much determined on what stock, knowing the stock. So what I always tell all of my students is, for the last 4 years, I've had about the same 15 or 20 companies on my watch list. So you'll see my watch list over here, and you'll see I usually trade within the same 20 or 30 stocks. Of course, when a new stock comes out, something like a CCIV or, something that just came out like, Coinbase or whatever it is, yes, they'll get added to the list. But the thing is, I tend to trade the same, 20 stocks day in and day out, because what happens is I tend to pick up on the patterns. I start to learn how these stocks move. I start to learn them like the back of my hand. I used to trade AMD stock, which is the chip manufacturer that makes like the chips for PlayStation and the new Xboxes and like computer parts. I used to trade them, I would say 6 to 10 times per day. I literally had AMD like the back of my hand. Literally traded them anywhere from 6 to 10 times per day. And that's why you want to just trade the same stock day in and day out and learn how they move, learn how they fluctuate, learn how they react to news.
You recommend starting with day trading, right? If you're a beginner.
If you have time.
How to do that first.
If you have time, I suggest it because, so on average, since 1926, remember I said before, the S&P 500 index, right? It's the overall, we usually use that to measure how the overall health of the economy is doing. So when anybody is ever talking about the health of the economy or how good or strong the economy is, they're mainly basing it off of the SPY, the S&P 500 index. Okay. Since 1926, when we started collecting data on it, it on average moves anywhere from 9.5 to 11% per year. As a day trader, you can make that in a matter of a day, a week, a few days, whatever it is. So learning the skills of day trading will actually benefit a lot more than just buying and putting away.
Right.
So because, what we want to do is we want to capitalize on these quick moves. So something like this with Riot right here, like you could see right over here, you got to remember, look, big red candle, right? So this level over here is very important to me. So we could see, look, let me draw a little line right here for you guys. So this right here, I would identify as my resistance right? So we could see right over here, it tried to break above this line. It failed to break it, right? Look at the strong red seller volume come in right at this red line, right? Strong seller volume comes in. So this would, I would identify as level 1 of my resistance. Now remember, I said you always wait on either 2 or 3. So look at this. It broke it, retested it, and now another giant red candle. Now, what does that show you? 2 giant red candles at the same level. Strong seller pressure there. So retested it again, failed it again, retested it again, and then crashed hard. So right here, let me put a little oval on.
There's a name for that, right, when we tested it twice?
Yeah, it's just a retest. For some reason the oval is not working. But you can see right over here is where I would actually enter my short. So I actually like when I actually take profits on a stock, what I'll actually tend to do is I'll try to identify multiple different key levels that it could potentially get rejected or find a support at. And then I'll have multiple different take profits. So we could see last time it was down over here, it actually, it bounced up, right? It found some buyer pressure right here. So this line right here would be my take profit 1. And then this line right here where it bounced last time to cover my short would be take profit 2. Now look at that. Take profit 1, I locked in half. Take profit 2, I locked in the rest right at the bottom. And I identified this short by the failure to break this key level multiple different times. And by identifying the strong seller pressure that came in every single time that it got rejected.
So one more question, without going into like too much detail. So especially with like Robinhood, you're only like allowed X amount of day trades, right?
Yes, you're only allowed 3 day trades in a 5-day trading period of round trip trades.
Right.
That's
Right.
because Robinhood only offers you a margin account and they don't offer you a cash account. So you don't need to tell me your account size. I'm assuming you're under PDT, so you're under 25K.
Absolutely,
What
yeah.
I would do is I would go over to TD Ameritrade, Weibo, E-Trade, Charles Schwab. There's a bunch of amazing brokers. All of them offer cash accounts. Robinhood is the only shitty broker that does not offer cash accounts. And that's because
Get
they're
off Robinhood.
yeah, get the fuck off that shit.
Okay. Gotcha.
So switch over to one of those brokers, and then when you're applying for it, they'll say, "Are you applying for a margin account or a cash account?" You click a cash account, and then you'll have unlimited trades as long as it's within your account balance, like I explained before.
Okay.
But
And then
go ahead.
How many are you allowed on then?
Unlimited.
Oh,
You're allowed unlimited up to the amount you have. So I was using the example before. If you have 10 grand in the account, you can spend upwards of 10 grand. So it could be 5 trades of 2 grand, 10 trades of 1,000 each, 20 trades of 500 each, and so forth.
Wait, TD Ameritrade, if you have $10,000, you're limited to trade with $10,000 options within a PDT rule. You cannot do more than 3 round trades.
That's if you're in a margin account. If you're in a cash account, you if you're in a cash account, you have unlimited trades. Yes.
Even if you have less than 25,000?
Yes. That's the purpose of a cash account. But the thing is, you need to wait for your money to clear.
Oh, yes.
Yeah, that's exactly what I was saying. So remember, I was using that $10,000 example, right? You could trade up to that $10,000 until the money clears again. So if you're trading shares of company, it takes 2 days clearance. If you're trading options, it's next day clearance. So if you remember, I was saying if you had 10 grand in the account and you're trading shares, trade 5 grand the first day and then 5 grand the second day. Day 3, the first 5 grand will be freed up again. That's exactly why.
But you need a margin account to trade options, right?
No.
Oh, wow, I didn't know that.
So then you can
You
trade
you
options
only
in a cash account?
Yes, you
which
can.
is unlimited?
Yep, I actually just so what I do is these things called SACs all the time. It's small account challenges. So I'll throw $1,000 into a cash account, have unlimited trades, and I'll try to multiply that account as quick as possible. I think I flipped either $500 or $1,000 into like $6,000 or $7,000 in like 2 months.
Shit.
So I had like a 600% return in that account in 2 months. But that's the whole purpose of day trading, like I said before, because if you just just buy stocks and put them away, right? On average, they'll return anywhere from 8 to 20% per year. You know, and if we're using the S&P 500 as a measurement, it'll on average return 9 to 11% per year. But as a day trader, your potential returns are so endless. So like even if I took this short on Riot right here, right? I shorted from the top, closed it at the bottom. Right there, I just made, look, 5.3% in a matter of probably an hour and a half.
But then why would not anybody would trade with cash account and then have a margin call when they can do unlimited trades?
You
Margin make more money, right?
Well,
with
well,
margin
the thing
call,
is, you can't get a margin call in a cash account because you're not borrowing the broker's money. The only way you could get a margin call in a cash account is if you get squeezed out of a short.
But for options you need cash. Margin call doesn't do anything good for your options.
No, well, margin actually doesn't matter for options because all you're doing is you're buying the rights to the contract. All you're doing is paying for the premium.
Right.
So you could have $500 in your account and you're buying the rights to $10,000. But the thing is, you just wouldn't have that $10,000 to exercise those rights. So like right now, let me pull up a contract of Amazon real quick.
You trade for 500 worth of premium contract.
Yeah. So I would buy a premium that's under $500, and I would have the rights to that contract, and I would resell that premium at a later date, hopefully for some profits. Harrison, I'll catch you later, buddy. Thank you for coming in.
I just have one question, like
Go ahead.
to that implied volatility, and as you were looking at that it's only moved from 32 to 35, so the price of the stock didn't move much, but I saw the volatility is like 100%. How is it?
It's
like moving every day, like 20, at least 25.
So the implied volatility is just pretty much a measurement of how often that stock moves. It's a measurement of the volatility of the stock. So the implied volatility is the expected change in volatility. So if a company or a stock is known to, move very drastically and very fast, like a penny stock or something like a Riot or a Mara, the volatility is very high, so your implied volatility is high. But something like Amazon, that's $3,200, $3,300 a share, the implied volatility is very low because it's been proven over time that Amazon does not move very often and very quick.
But then you get more return on them when you trade options on them.
Of course. So volatility is just pretty much a measurement of risk. So stocks that have low volatility are low risk, and stocks that have high volatility are high risk because they will fluctuate quicker in price.
Thank you so much, Steven.
You got it.
All right, guys. So this is a link to the Discord if anyone wants to join if you're not in already. And I hope you guys took something from this. Thank you all again, Steven. This is really, really important.
Of course. You guys are welcome. If anybody has any questions, just DM me on Discord, okay, guys?
All right.
All right.
Thank
Have a
you,
good night,
guys.
guys.
Have a good one.